In today's video, we're going to be talking about the biggest market moving thing that I can possibly think about, and that is central banks and their interest rate decisions in financial markets. This is one of the lead drivers of currencies, bonds, stocks. Everything reacts to what the interest rates set by central banks are doing. And in this video, I'm going to explain what the interest rates kind of are and how they impact the markets, and most importantly, how you can actually trade them as a intraday trader, swing trader, scalper. This stuff really moves markets, and understanding it can be a powerful resource to use in your trading. Let's jump in. So first of all, a central bank is, of course, the biggest banks of major economies. Like you have the ECB, which is the European Central Bank, the Bank of England, which is the UK, the Federal Reserve, which is the United States, you have the Bank of Japan, you have all these different central banks. And these central banks have an agenda. They're trying to keep the economy as strong as possible while not overheating and keeping people at work with jobs, that sort of thing. They have kind of a goal here. And they use interest rates as their primary weapon to help to control this agenda. So what I mean by that is a central bank has a base rate or a interest rate that they can set for borrowing and lending in their respective economies. So this base rate is controlled and set by an economy's central bank. Now, if you are trying to buy a car or buy a house, you need to take loans, right? Well, those loans and that rate that you pay interest back to the bank is actually set at the top level by a central bank. And so you can see how this has a huge implication on the whole economy as to how affordable or unaffordable or inaffordable, I'm not sure the right word.
Unaffordable.
Not as easy to get loans or easy to get loans that are at good rates. So let's talk about that a little bit more. Now, a central bank may want to increase an economy's growth, or it might actually need to decrease an economy's growth. And there's reasons for this. A lot of growth in an economy can lead to a lot of inflation, and a lot of inflation can actually lead to meltdowns, recessions, and really bad stuff. Now, growth causes inflation because if companies are hiring more people and giving them wage increases and people are out buying cars and houses, you can see how lots of money is getting spent, and pretty soon prices start to rise very quickly. And that can lead to some really dangerous spots. So a central bank may need to use their interest rates to make borrowing easier or harder for citizens, people of the country, that's so on and so forth. So an example here is I've got this little chart here. So I want to show you two different sort of scenarios. If a central bank wants to increase growth in an economy, what it might do to increase that growth is to actually lower interest rates. Now, by lowering interest rates, the central bank makes it easier for people to go out and get cheaper loans to buy houses, to buy cars, and it allows businesses to borrow money at a cheaper rate so they can get back out there and hire more people. So if an economy needs to grow, if there's a real bad need for growth, a central bank of that economy may choose to actually lower the interest rate at the highest level. On the flip side, a central bank that wants to kind of slow down the economy so that it doesn't overheat might do the opposite. They may actually raise their interest rates or hike interest rates to start to try and slow down or calm down the economy so that things don't get out of control. So again, it can be kind of confusing because people would say, why not just keep interest rates low? Don't you want your economy to grow as fast as possible? And there is actually some science here to this, at least in Western economic philosophy. Too much growth too quickly can be really bad. And of course, it goes both ways. You want an economy to grow, but you don't want it to overheat and grow too fast. So we'll talk about that a little bit more. So let's walk through a little bit of an example here, and you'll see hopefully why interest rates may need to be hiked in certain scenarios. So if an economy is experiencing tremendous growth, like let's say it's just booming and things are great, inflation can start to occur as wages start to get increased from employers who are more competitive for people who need jobs. So job growth is again very competitive, and when that happens, people or employers need to start paying people more, and they give people raises, and this leads to people having more money in their pocket, and people go out and spend it. This is what is called inflationary. It causes prices to go up. And that doesn't sound too bad until you realize if inflation starts to get out of control, it can actually destroy the consumer's purchasing power. It's kind of weird, right? You would think, well, people are getting paid more, they should be able to buy more things. That is true to a certain point, but if everybody's just rushing and bidding up all the prices, what happens is it starts to get out of control, prices go way too high, and then there's kind of a collapse, and that can be really, really ugly, like you can see in my perfectly to scale, brilliant drawing here. I'm just kidding, it's just an illustration. This can lead to a really big crash, and it's really, really ugly, and it's happened in the past. An example of this would be the Great Depression, right? The Great Depression, we saw people in the United States just going, actually pretty globally, people were buying stock shares like crazy and real estate, and everybody was thriving. And of course, that's great when times are good. But what happens is that when things start to kind of fall apart, it can actually devastate a group of people, and actually even leave them way worse off than things that, when it first started. So there is a healthy level of growth that central banks kind of target, and to help with this is where they use interest rates to try and normalize the growth that's happening. So central banks closely monitor inflation to avoid these catastrophic situations where inflation goes hot and then they have to, basically put people into a terrible situation. There's a natural cycle to this that the central banks are after, and we're going to go into kind of a more detailed example here. So just a heads up, this is definitely oversimplified when I go through this here. This is just a really high level example of what might happen. The problem with financial markets and with, knowing the future is that nobody knows the future for certain, and central banks are doing their best to take the data that's in front of them and make decisions, but no two rate hiking or rate cutting cycles are identical to one another. There's always new things, like right now there's like the growth of AI, and we had the Russian invasion of Ukraine. Every single situation in markets is unique, and so central banks are doing the best they can to try to keep inflation and try and keep growth at a relatively steady pace. So let's do a really simplified example. Phase 1, growth is slow, labor market is weak, and the central bank decides to cut interest rates. Now, this is a theoretical example. So we're saying, so the growth of an economy is really slow. Things are not doing very well, and the labor market is weak, people are unemployed, and there's a problem. So the central bank looks at that situation and they say, okay, we need to cut interest rates to make borrowing more accessible to companies so that they can get out there and hire more people, get people back to work, etc. So this is an example of when a central bank may choose to cut their interest rate, meaning lower their interest rate so that borrowing is cheaper at the highest level. This makes borrowing money cheaper, as mentioned. And what it leads to is companies start to hire and companies start to see growth because more people are getting paid, and then the gears of the economy start to turn. And what causes this, or what this causes in financial markets for us as traders, is this little section right here. During this period of growth, what we start to see is that the dollar starts to fall as people get out of cash and they start going more into stocks. Stocks tend to rise during this time, and bonds tend to rise during this time as people are selling off the dollar in favor of more risky assets and investing their money that they may have left over from all of this prosperity. So we typically see during this time stocks do well, bonds market might rise as well, etc. Phase 3, growth is really strong. The labor market is now also strong, and we start to get a little bit of inflation. So prices are starting to heat up. And the central bank may look at this and say, okay, we've had a lot of growth. Let's get this thing to be a little bit more under control so we don't run off the rails here. So the central bank may then choose to start slowly hiking interest rates. That doesn't mean that they're just just going to raise interest rates dramatically all of a sudden. They may just say, hey, let's just keep this growth in check by slowly raising interest rates. So the US dollar in this situation actually starts to rise as people are saying, okay, well now the dollar is looking a bit more attractive. And at the same time, we have stocks typically starting to see some retracement, starting to see a little bit of pullback, a little bit of suppression, and bonds also typically fall in this environment. So this cycle, you can start to see it tends to repeat over and over and over, because now you can see on phase 3 here, we're starting to look back like we are getting closer to phase 1, right? Where growth starts to slow next, and we start to get back into, hey, there's a weak labor market again. Maybe companies needed to lay off once interest rates started getting pretty high. And now we're back to square one. So you can see on number 4 here that the cycle typically repeats itself over and over. The blue line representing inflation, right? And so as inflation is starting to rise, interest rates, this might have been the product of interest rates being cut, and so on and so forth. As interest rates get hiked again, inflation starts to fall, and so on and so forth. You can see that this typically happens over and over again. Now, why I said this is overly simplified is because there's always external forces, and I'm going to call them other contributors to what a central bank has to kind of deal with, right? If you're a central bank during World War II, you can imagine the stress that central banks had to kind of put up with during that time, as a war, for example, demands a lot of money to fund. So let's talk about other contributors to this equation, right? Interest rates are what central banks are using to slow or moderate an economy, or to stimulate an economy that has slowed down tremendously. So you can see interest rates are very, very important to markets. And economies are very much fixated on trying to grow at a nice pace, but not overheating. And so this whole equation, as traders, you and I can very much gain some important storytelling aspects of the market by understanding what interest rates are doing. So if we see a trend to the upside in interest rates, raising interest rates from central banks, there's trades there that can actually be taken advantage of. And if they start to cut interest rates or hinting that there might be rate cuts in the future, we as traders can jump ahead of the curve and start to look for opportunities in that direction. So again, this is why interest rates are so important to financial markets. Let's also now talk about other contributors, because remember I said that was overly simplified. This is why. They're just the nature of the real world. There's always other contributors. For example, if oil prices are rising, think about when you go to the pumps and you have to pay for gasoline. Sometimes it hurts a lot more than other times. When it hurts a lot more, that is inflationary, because all of consumers are having to pay more at the pumps. And with that, companies who are paying for oil themselves, they have to pass that cost onto their consumer, their customers, right? So if you're a company that, let's say you're a grocery store and you have things on the pantry or things on the shelf that people need to buy and put in their pantry, that sort of thing. Well, to get bread onto the shelves, there's like planes and trucks and cars and stuff that have to move it all around. And if that energy cost for those vehicles to move the stuff around in transportation, energy has a huge impact on inflation, and hence can actually throw a loop into a central bank's game plan. The reason that this matters so much is every supply line relies on energy or oil or gas, whatever it is, to actually move product around. And so if energy prices are rising, if oil costs are going up, it can be very much inflationary to an economy. So that's just one situation. Another example is what I mentioned earlier in the case of war. If there's a war going on, central banks may be required to print a ton of money, which can cause a lot of inflation and can have some repercussions where central banks may need to really look to raise interest rates to combat that inflation, which can have huge implications on markets. Just remember, if interest rates are rising, it's likely going to cause dollar strength, and it's going to likely cause stocks to start to tumble, so on and so forth. Some current examples of this are the Russia and Ukraine situation, like I mentioned earlier. When Russia invaded Ukraine in 2022, that was very inflationary for many places because a lot of spending had to go into Ukraine from a lot of the Western allies, and same thing with Russia. Like this is that just requires a lot of spending, and a lot of spending leads to the pricing power of dollars, of euros, of whatever is being printed to decrease in value. So that can be very inflationary and can cause the central bank to react. Now, on top of this, supply lines being interrupted can be very inflationary. So again, going back to Ukraine as well as the COVID situation, both of these events caused major issues in the supply chain. COVID is kind of a more easy example. Everybody kind of shut down, and all the parts for cars and all sorts of supply line stuff got slowed down. And that means that there's a high demand for product, but very little bit of supply. And so prices get rising fast. And so that can be very inflationary as well, also throwing a loop into the situation for central banks to decide what to do with their interest rates. Not to mention with the COVID situation, there was also a ton of stimulus that was printed worldwide, especially in the US. There was a very big, massive push of stimulus. And, a lot of times people, not to get political on this stuff, but government programs can also be inflationary. When tons of money gets printed or handed out, or people want free things, nothing in this world is free. And when it comes to free incentives or free programs from governments, what it really actually ends up meaning is that you, me, and everybody involved in the country that is doing those programs, we end up all paying for it collectively at the store, at the pumps, wherever we're going to buy products. Prices are going to rise because printing of money does not mean it's free for everyone. It means you and I pay way more money for our products and services. So, during 2020, there was massive amounts of stimulus, and now here years later, all of us are paying for it, right? Tons of money got printed. I'm not saying by any means that people who are in dire situations did not deserve the help they got. I'm just saying that there's always a repercussion. When printing money, when incentives happen, that is incredibly inflationary, and central banks oftentimes have to do something about it. So when there's tons of inflation in a system, in order to get that inflation under control, interest rates can be expected to rise, and those things can again be dollar bullish and bearish for indices, etc. And I drew this little drawing here, the Cheerios box, because I don't know if anybody else has noticed this, but how when you go to the store, what used to be much cheaper in terms of like a cereal box is an easy example, is now much more expensive. And notice something about my drawing here. Notice another thing they do, another trick they do at the store, is they do something what I like to call shrinkflation, where the old box of Cheerios, or I don't know if it's Cheerios specifically, but many products, they used to have bigger boxes. Now the boxes have been reduced in size, which is a quiet way of not rising prices as much, but still reducing how much is given to you when you purchase a product. Anyways, I thought that was kind of interesting because I've noticed it at the stores myself. The products that I've bought for years, not only have their prices gone up, but the size of the packaging has actually gone down. That is crazy. But again, just another example of inflation in the act. So next up, let's talk about how I use this. So interest rates play a key decision in my trading process. It is a very important component to my trading, and I factor inflation data and interest rate data into my trading decisions. And I'm going to show you about how to do that in just a second with our software, which actually automates this process to help me find better trading setups in the market. So I'll jump over to the chart now. Okay guys, so I just wanted to show you a little bit of how the interest rate numbers are impacting I guess my personal strategy, but also the software that our team has built. Economic data, inflation, unemployment figures, all sorts of stuff. All of this stuff is very, very important, but what is difficult is looking at all of it at the same time. What our software does is it pulls in all of the data, the interest rates, the job statistics, inflation, GDP. It pulls in a ton of market data and it generates biases based on this thing. So in this video, we're talking specifically about interest rates and how important they are, but so is labor and inflation and growth in an economy. And what our software aims to do is take into account all of these economics or the fundamentals and score them together to produce biases in the market. So right now, the US economy has been relatively strong compared to other places, and interest rates have been very stubbornly high. So what you'll notice is that across the board, we're getting a lot of dollar bullishness from our signals here under the score column. All this is doing is taking into account all of these statistics, all of these numbers, and giving us a nice bias. So I use the EDGEFINDER to find the setups that I trade. And if you do want a copy of this tool, we work very, very hard to keep the algorithm tight and considering lots of market data. So if this would be something that you'd like more information about, please feel free to message us using the link in the description down below. There is a direct message center where you can basically have a conversation with someone on my staff about the tool. And if you'd like, you can actually even set up a call with us if that's something that you think would be useful to you in your trading. Many traders are using it every single day to help them find more fundamental and economic figures-based trading setups. If you're looking to improve as a trader, we've got some cool free resources here that I wanted to share as we close today's video. Down below in the description, there is a link to join our Discord channel or our Telegram channel. And we also have our website, a1trading.com, where traders can get access to free course material to help you improve as a trader. Remember, we are also live Monday through Friday on this channel around 9:30 a.m. US Eastern, broadcasting most live news events and that sort of thing. So hope to see you there. And also, we do have a couple videos here showing up on the screen. If either of these seems like it might be helpful to you, then make sure to click here or here, and we'll see you there.